Hi, everybody. Happy 2024. I hope everybody's New Year's off to a fantastic start. We wanted to provide our latest market commentary, not only for quarter one, but also looking forward into all of 2024. First, let's look back at 2023 and do a quick recap. 2023 was quite the year. Double-digit stock market returns, and that's all. And that all happened in a very uncertain year. I believe 100% of the economists that were polled on Bloomberg Research in January of 2023, 100% of them were predicting a recession at some point in 2023. That obviously was not the case, and then market proved resilient, and we had a fantastic year. That's with a lot of uncertainty and a lot of bricks in the walls of worry. We had financial regional banking crisis in the spring. We had debt ceiling turmoil. We had rising interest rates throughout the year. We had another war break out. All that being said, the market continued to go up last year. Looking into 2024, there's still a lot of noise out in the world today. You flip on the news and it seems like only bad news. We wanted to highlight a few things as we look into 2024. First of all, we believe over the long term, the stock market is driven by two things. When we take out all the noise and boil it down. First thing is corporate earnings. Okay, what that means, if corporate earnings and company earnings continue to increase, and again beat analyst expectations of earnings, the stock price of those companies will go up over the long term, no matter what noise or short-term volatility there may be. If companies earn more money, their stock price will rise. Okay, that's the first thing. Second thing is interest rates. Valuations for everything, stock prices, bonds, real estate, your home, is tied to interest rates. And it has an inverse relationship toward interest rates. What I mean by that is if interest rates were to go up, valuations would come down. Prices were to come down. That's what we saw in 2022, somewhat in 2023. Likewise, when interest rates come down, valuations will go up. And I'm saying that because in their December meeting, in the Federal Reserve's December meeting, they hinted that rate cuts were possible for 2024, this year. The problem is they provided no indication of when they're going to cut interest rates. With this lack of clarity of when they're going to cut interest rates, we would not be surprised to see the market drop, especially in the first quarter, into correction territory. A correction is 10% decrease from the highs, but not more than 20% decline. Okay, corrections are very typical in any given market cycle. They're very normal. Okay, so we wanted to highlight this because we are going to see some volatility, especially in the first half of this year. But again, this is very normal, and it is because, and what's driving it is interest rate cut uncertainty as far as timing. Okay, so what does this mean as we look into 2024, and what opportunities are there? We highlighted this this fact in our last market commentary that we released back in October. We'll provide a link to it if you wanted to check that out. But this is an ideal opportunity to get cash off the sidelines. Okay, a lot of people flocked to money market funds over the past year or so. Money markets are paying 5% at Schwab with us. They're paying 5.25% per year. That is very attractive, no doubt about it. Hey, I get protection of capital preservation, but now my money is earning 5.25%, which is a heck of a lot better than what the banks are paying. But staying in money market may not be the best option for cash that is not needed in the short term. If you have cash that's in a money market and you don't need it for the next year, 2 years, 5 years plus, it probably makes sense to shift it into either fixed income bonds or equities, stocks, and have a reallocation or a more aggressive objective. The reason for that is we've gone back and researched, and we'll put up a graph here in a minute. Following the last 4 Fed rate hike cycles, so after they get done hiking rates and they start to pivot and start to lower interest rates, stocks and bonds greatly outpaced money market and short-term bonds, cash. Okay, and the reason for it is when rates come down, that money market's no longer paying 5% plus. It's now paying 1, 2, 3% less, depending on how much they cut rates. So, again, as they lower rates, as we mentioned, stocks, bonds, real estate valuations will go up. Okay. With that said, about rate hikes, 2024, as they look to cut rates, we think this will create much more of an inclusive market for 2024. 2023, story there, yes, the market went up, but it was really driven by 7 stocks. They're called the Magnificent Seven. It's Apple, it's Google, it's Microsoft, it's Amazon, it's Meta or Facebook, and Tesla and Nvidia. And a lot of those companies were involved in AI, and again, it led to some pretty substantial growth for those companies back in 2023. The rest of the market, the other 493 companies, they were up, but very modestly, 5 to 7% for the year. It was really big tech that pulled everybody else along. So, bottom line, and in conclusion, as we look at 2024, markets are going to remain volatile for 2024. We don't foresee the same type of volatility that we've seen in years past, but again, Fed uncertainty around interest rates is the key driver. All eyes are on the Federal Reserve and what are they going to do? When are they going to cut rates for this year? Also, hey, we have an election this upcoming November. We've gone back and researched and determined, hey, what happens in election years? Ultimately, red president, blue president, whatever it may be, performance tends to be about the same, no matter who ends up in the Oval Office by the end of the year. What we do see though, is more volatility typically happens in the first 4 or 5 months of the year on an election year during the primaries. Okay, we're not saying this is the rule and that's what's going to happen, but again, this is what the trends in history shows, that in the first 5 months of an election year, the markets are typically more volatile. After we get through primaries, they tend to bounce back and actually do pretty well for the rest of the year. We're not trying to time the market by any means, but a prudent strategy that you could employ if you do have cash on the sidelines and wanting to put it to work is to implement a phased-in dollar cost averaging approach. Hey, I have $50,000 that I want to put to work. Hey, I'm going to invest $10,000 into a given strategy for the next 5 months. That way, you're not trying to time the market and alleviate any timing risk. We're happy to talk about any opportunities or any questions that this commentary might bring up in your head. At the end of the day, guys, you can be confident that we'll continue to monitor all the circumstances and economic conditions that we're currently going through. If there's anything that you all need to be aware of, we'll provide either a video or send out more commentary or write-up or anything like that just to keep you well informed. But there's going to be a lot of noise this year. We got the election. We still have wars in Ukraine and in Israel. Worsening tensions between China and the U.S., potentially in Taiwan. There's going to be a lot of noise in the media. As we've mentioned before, now more than ever, we need to put our fear on the sidelines, put emotion on the sidelines, and invest for the long term. Keep a long-term perspective. That's how we get through times of volatility. As I mentioned at the beginning of this commentary video, everybody was predicting in January of 2023 a market decline, a recession. That obviously wasn't the case. So no matter what the talking heads are saying or whatnot, nobody knows what's going to happen in the short term. So that's why it is important, as I mentioned now more than ever, to maintain that long-term perspective and ensure that your risk that you're taking into account aligns with the objective for those funds. We're here. I wish everybody a very prosperous and happy 2024, and I look forward to seeing everybody in the months to come. Take care. Thanks.